right, so the presumption is that before you listen to this PowerPoint presentation that you have already listened to the Chapter 9 lecture. If you have not done so, please go back and do that first, and then this will make a whole lot more sense to you. Let's dive in. Exercise 9.2. All right, so below are a few transactions and events for Piper Company. They record a year-end entry of $10,000 for previously unrecorded cash sales costing $5,000, and they have a sales tax rate of 4%. They earned $50,000 of $125,000 previously recorded in advance for unearned services revenue. And they want us to prepare the adjusting entries at December 31st for their year-end financial statements. So they record a year-end entry of $10,000 of previously unrecorded cash sales costing $5,000. So we're going to record our sales for $10,000. We're going to record our payable to sales tax of 10,000 times 4%. We're going to record cash of $10,400. Okay. Then in part B, the company earned 50 of their 125 previously unearned services revenue. So we're going to, let me back up. We have to record the cost of goods related to our sales. So we debit cost of goods sold for the $5,000 and credit merchandise inventory for $5,000. Then in part B, we're going to reduce our unearned services revenue. We do that with a debit, and we're going to do that for $50,000, and we're going to record service revenue earned of $50,000 with a credit. All right, so same problem, different numbers. Why don't you take a stab at it? And when you think you're finished, you can resume the recording and we'll go through the answers. All right, so Piper Company records a year-end entry for $160,000 of previously unrecorded cash sales. Cost $80,000, sales tax rate of 5%. Company earned revenue of $32,000 from a previously $80,000 received in advance. So prepare our entries. So the first entry, we're going to record our sale, credit to sales for $160,000, credit to sales tax payable for $160,000 times 5%, then debit to cash for the total. Then we have to record our costs, so we're going to increase our cost of goods sold for $80,000, debit at $80,000. We're going to reduce our merchandise inventory for $80,000 with the credit. Then we're going to earn $32,000 of our previously unearned revenue. So we're going to debit unearned services revenue for $32,000, and we're going to credit earned services revenue for $32,000. All right, in exercise 9.3, Salvestor Systems borrows $110,000 cash on May 15th by signing a 60-day 12% note. So on what date does the note mature? Well, May 15th plus 60 days. We've got 16 days in May, 30 days in June, and 14 days left to get to 60 in July, right? So that means our note matures on July 14th. So assume that the face value of the note equals $110,000, the principal of the loan. Prepare the journal entry to record the issuance of the note. So we've got cash of $110,000, debit, and credit to notes payable for $110,000, right? Then, in B, prepare the journal entry to record the payment of the note at maturity. We're assuming a 360-day year and do not round intermediate calculations. So what that means is we have our $110,000 times 12% times 30 divided by 360, or $2,200 of interest over the entirety of the note. So we're going to reduce our note payable when it matures with a debit of $110,000, and we're going to record our interest expense of $2,200, and we're going to credit cash for the total. All right, so same problem, different dates and numbers. Why don't you take a minute, see if you can't answer the question here. Number 1, on what date does this note mature? Then when you're finished, resume the recording. We can go through it and we'll move on to the other parts of the problem as well. All right, so on what date does this note mature? Well, 15th to the 31st of May, 16 days. 31st of May to the 30th of June. Oh, I'm sorry, this is a 30-day note. So we've got May 15th to May 31st, 16 days. May 31st, you need 14 more days to get to a total of 30. So that means the note matures on June 14th. Assume the face value of the note equals $180,000, the principal of the loan. What's our journal entry? Debit cash, credit note payable, right? We got cash from the bank in exchange for a note. All right, so then in part B, they want us to record the entry at maturity. So interest is principal times rate times time, right? 180 times 7% times 30 divided by 360. They don't know how to do math. This is an error. This should be $1,050. So then our journal entry to record that at maturity, we're going to reduce our note payable. We do that with a debit. We're going to record our interest expense, $180,000 times 7% times 30 divided by 360. It's a debit of $1,050, and we're going to credit cash for the total. All right. Exercise 9-4. So Keisha Company borrows $200,000 cash on November 1st, signing a 90-day 9% note with a face value of $200,000. What date does the note mature? Well, you have 30 days in November, or 29 days in November, rather. You've got 31 days in December. You've got 30 more days you need to get to 90. So 30 days in January is going to be January 30th, right? So the note's going to mature on January 30th, 2019. What's the amount of the interest expense recorded on December 31st, 18 and January 30th, 19? Well, interest is principal times rate times time, right? So you got total interest of $4,500. I should probably check that math since I didn't do it right on the last one. 200,000 times 9% times 90 divided by 360 is $4,500. So through maturity, they're paying a total of $4,500 in interest. But through the end of 18, they're only paying, what is that, 60 days worth? 29 days in November, 31 days in December. So 200 times 9% times 60 divided by 360 is $3,000. And then in 19, they're paying 30 days worth of interest, or $1,500. Okay. So now they want us to prepare the journal entry to record the issuance of the note on November 1st. So we're going to record cash of $200,000, and we're going to record our note payable with a credit of $200,000. Then we have to record the accrual of the interest at the end of 18. So we computed the 18 interest to be $3,000, so we're going to debit interest expense for $3,000 and credit interest payable for $3,000. Then we need to record the journal entry to record the payment at maturity. So we're going to reduce our note payable. That needs to go away. We do that with a debit of $200,000. We need to reduce our interest payable for the 60 days we accrued at the end of 16 or 18. So that's $3,000. Record our interest expense for the $1,500 that applies to the 2019 year. We're going to credit our cash for $204,500. Okay? All right, so same problem, different numbers. Why don't you take a try at this one, and when you are finished with this first question on what date does the note mature, resume the recording and we'll go through the answer. All right, so we've got 29 days in November. We have 31 days in December, and we need another 30 to get to a total of 90. So that means our note matures on January 30th. And then why don't you take a minute here and compute what the interest expense is that's recorded on December 31st, 18 and January 30th of 19. Remember, interest is equal to principal times rate times time. All right, so let's see how you did on the interest. So we have 120,000 times 9% times 90 divided by 360. Let me make sure their math is right here. So that should be total interest of $2,700 split as follows. You've got 60 days in 18. So 120 times 9% times 60 divided by 360. It's $1,800. And then in 19, you got 120 times 9% times 30 divided by 360, or $900. All right, so now prepare the journal entry to record the issuance of the note. Debit cash, credit, note payable, right? And then prepare the journal entry to record the accrual of the interest at the end of 18. Well, we computed it to be this $1,800, right? So we're going to record interest expense of $1,800 and interest payable of $1,800. And then in the last problem, prepare the journal entry to record the payment of the note at maturity. So we have notes payable. We're going to reduce our balance. So we had a credit of 120. We need a debit to take it to 0. We're going to reduce our interest payable that we accrued at the end of 18. So we're going to debit interest payable for $1,800. We're going to record our interest expense for the other 30 days. So that's $900. And we're going to credit cash. $122,700. All right, so hopefully you did well on that one. Exercise 9.5. So BMX Company has 1 employee. FICA is 6.2. The first $127,200 paid to its employee. And the FICA Medicare taxes are 1.45. For BMX, its FUTA taxes are 3.1. Its SUTA taxes are 2.9 of the first $7,000 paid to its employee. So what they're asking for us to do is to compute each of the above 4 taxes as applied to the employee's gross earnings for September under situation A, B, and C. So, under situation A, where they have gross pay through August of $6,400 and pay for September of $800, the earnings subject to FICA Social Security are all earnings. So 6.2% times $800 is $49.60 for September. FICA Medicare, all the earnings are subject to FICA Medicare. So we have $800 subject to 1.45 or $11.60. And we have FUTA, they tell us, are 3.1% of the first 7,000. So 6,400 times 800 or plus 800 is greater than 7,000. So you only need $600 in September to reach that $7,000 threshold because they paid 6,400 through August. So you only have $600 that are subject to it. So that's $600 times 3.1%, which is $18.60. And then SUTA, they tell us, is also the first $7,000 paid to employees right here. So you have 600 more for September because you've already paid it on 6,400. You need 600 to get to 7,000 total, so you're only subjecting 600 of the 800 in September to that tax, times 2.9%, or $17.40. Right? And in situation B, gross pay for September is $2,100. Year to date through August is $2,000. So all earnings are subject to FICA Social Security because they tell us that it's 6.2% of the first 127,200 paid to its employee. So we're nowhere near that, right? Same thing for Medicare. So all earnings, so all 2,100 for September times 6.2%, $130. Same thing for Medicare, all earnings times 1.45%, it's $30.45. And then all earnings would be subject to FUTA because we haven't reached that $7,000 threshold. So that's times 3.1%. And then same thing with SUTA. We haven't reached the threshold. Times 2.9% for a total of $60.90. Okay. Then in situation C, we have a total gross pay of $128,900 through September. And they tell us that only $127,200 is subject to Social Security and Medicare. So we're only going to take the $6,300 that we need to get from this $129,900 to this $127,200. So that's $6,300 of the $8,000 earnings for September that are subject to FICA, Social Security, and Medicare. So 6,300 times 6.2%. Medicare. Oh, I'm sorry. The FICA Medicare taxes aren't subject to a threshold. So all wages are subject to FICA. So $8,000 times 1.45%. All earnings are exempt from FUTA because they've already reached that $7,000 threshold in the gross pay through August. And the same thing is true for SUTA. Okay. All right, same problem. Different numbers. Why don't you take a few minutes and see if you can figure out for each of the individual scenarios what the taxes are for situations A, B, and C. All right, so let's see how you did. So in situation A, we have 6,500 pay through August, 900 pay for September. They tell us that gross pay, well, then gross pay through September is $7,400. So all wages are subject to FICA Social Security. So $900 in September times the rate they give us is 6.2. Total tax amount of $55.80. Then Medicare, $900 September earnings subject to tax times 1.45%, 13.05. FUTA, the first 7,000 is subject, and SUTA, same thing. So we only need $500 of our September pay to be subject to FUTA, not the whole 900 because we had 6,500 through August, so we need 500 more to get to 7,000. So 500 times 3.1%, or 15.5. And then SUTA, same thing, times a different rate for a total of 14.5. Right? Then in part B, we had 2,000 of gross pay through August. We had 3,000 gross pay in September. So that's a total of 5 through September. So all 5 is going to be subject to all of the rates. So we have 3,000, or all three, I'm sorry, of September. 3,000 times 6.2, 3,000 times 1.45, 3,000 times 3.1, and 3,000 times 2.9. Okay. And then in situation C, we have $121,200 gross pay through August. Our pay for September is $9,000. We have $130,200 total, but the first $7,000 subject to FUTA and SUTA was paid a long time ago, so those are zero now. Then of our $130,200, 3,000 of it is exempt because we're only paying FICA Social Security on the first 127.2. So we've got $6,000 times 6.2, or $372. And then all of our earnings are subject to FICA Medicare. There's no threshold on that one. Times 1.45, or $130,050. All right, exercise 9.6. So BMX has one employee. Social Security is 6.2% of the first $127,200 paid to its employee. FICA Medicare is 1.45%. And for BMX, its FUTA taxes are 0.6, and its SUTA taxes are 2.9 of the first $7,000 paid. So they want us to prepare the September 30th journal entry to record the salary expense and related payroll liability for this employee. So the federal income taxes withheld are $80 for this pay period. So let's compute what the earnings are subject to tax. So FICA is 6.2%, and the first $127,200 paid to the employee are subject to that 6.2. So all earnings for September are subject because gross pay through August was only $6,400. So $800 times 6.2%, $49.60. Medicare is all wages. So all $800 for September are subject to the 1.45. The FUTA taxes, first 7,000 is subject. So $6,400 pay through August, plus only $600 would get you to the max of 7. So only 600 of the 800 is in September is going to be subject to the tax. So 600 times 60.6%. And then same thing is true of FUTA, or SUTA rather. Only 600, 2.9%, for a total of $17.40. So now, the journal entry to record the pay would be salary expense, total of $800. FICA Social Security tax payable for $49.60. We credit that. We credit our Medicare tax payable for $11.60. We credit our federal income tax payable, which they tell you is $80, right up here. And the net is your salary payable to your employees. Same problem, different numbers. Why don't you take a stab at it and see how you do. When you're done, you can resume the recording and we will go through the answers. All right, so BMX company has one employee. They give us the pay through August and the pay for September. They want us to prepare the September 30th journal entry and related salary expense. So let's compute what the taxes are. So Social Security, the first $127,200 is subject to Social Security tax. So that's all $1,100 for September times 6.2%. Medicare, all earnings are subject. So 1,100 times 1.45%. Then the first $7,000 is subject to the FICA, or to the FUTA and the SUTA, but we have gross pay through August of $6,800, so we can only have another $200 that's subject to that tax. So you have $200 times 0.6, and then $200 times 2.9. Then our journal entry is going to be to salary expense for the gross pay for September, $1,100. Then we credit all of the tax payable accounts. So FICA Social Security tax payable, credit for $68.20. FICA Medicare tax payable, credit for $15.95. Employee federal income tax payable, credit for $170.50. And salaries payable for $845.30. Okay, exercise 9-7. All right, so in this example, it's the same numbers from the problem 2 problems ago, the one that we did together before you did one on your own. The only difference here is they want us to prepare the employer's payroll tax journal entry, where the one before was just the employee side. And so the employee side, you don't record the FUTA and the SUTA because that's an employer only paid tax. And so let's look at how we would prepare the employer side. So the employer side, you have your September 30th journal entry. So let's compute the employer side of the taxes. So Social Security and Medicare, the employer is going to recognize the same amount as the employee side. So the Social Security, the entire earnings, both the gross pay through August and the pay through September, is less than $127,200. So the whole $800 for September is subject to Social Security. So you have $800 times 6.2%. Medicare, all earnings are subject, so you've got your $800 times 1.45. And then your FUTA, it's the first $7,000. So $6,400 less $7,000 is $600 of the $800 pay for September that's going to be subject to FUTA times 3.1%. And then same thing for SUTA, only $600 of the September pay, because that's when you reach the $7,000 threshold, is going to be subject to the SUTA taxes. Okay. Then the journal entry on the employer side is the payroll tax expense for the grand total. But let's do all of the credits first. So you have your FICA Social Security payable for $49.60, Medicare payable for $11.60, your FUTA tax payable for $18.60, and your SUTA tax payable for $17.40. So the sum total of all your credits leaves you with a debit for payroll tax expense of $97.20. Okay. All right, so same problem here. Why don't you take a stab at doing the employer side of the payroll journal entry? And then when you're finished, you can resume the recording and we'll go through the answers. All right, so let's compute the taxes for each of the categories. So you have FICA Social Security. All wages are subject to that, up to $127,200. So we haven't reached that in September, so all $1,100 is subject to 6.2%. Medicare, all earnings are subject to the 1.5%. The FUTA, let's see, it's up to $7,000, so $6,800 gross pay through August. So that means we can only take $200 of the pay for September and subject it to the SUTA and the FUTA. So $200 times 3.1% and $200 times 2.9%. There's your total taxes for all of the employer paid items. So our journal entry is going to be to payroll tax expense debit, and we're going to credit FICA Social Security payable, we're going to credit Medicare payable, we're going to credit FUTA payable, and we're going to credit SUTA payable, and our debit is for the sum total of all your credits. Okay? So hopefully you did well on that one. Let's move on. Exercise 9-8. So the following data is taken from Ramirez Company, and they want us to complete the table below. So total medical insurance premiums are $7,000. The employee percentage of that is 40%. They tell us that right here. Employee pays 40%. Oh, where's my? Employee pays 40% of the medical insurance premiums. The premium paid by employees is going to be 7,000 times 40%, or $2,800. And then the premium paid by employers is going to be 4,200, which is the difference between the 7,000 and the 2,800. And then the life insurance premiums are $4,000. The employee portion is 40%, so 4,000 times 40% is 1,600. 4,000 minus 1,600 is 2,400. Then they want us to prepare the journal entry to record the accrued payroll, including the employee deductions for July. So we have salary expense for sales of 300,000, so we want to debit salary expense for 300,000. We have office salaries of 60,000. So we have our 300 and our 60. Federal income taxes withheld that are going to get remitted to the state, so we want to credit federal income tax. That'll be somewhere here. Let's move on to FICA. They don't have it in the same order as the problem. So FICA Social Security tax payable is going to be the $360 of total salaries times 6.2%. So we credit that payable. Then the FICA Medicare tax payable is going to be our total wages times 1.45%. Employee federal income tax payable is going to be that $90,000. They give us that. Then we have our employee state income tax withheld, so that's going to be your $20,000. You want to credit that payable. We already did Social Security and Medicare out of order. And then we have medical insurance payable. So they told us the medical premiums were $70,000, but the employee are paying for 40% of that. So we withheld 40% from their paycheck that we have to remit to the medical insurance company, right? So we have a payable until we do that. So that's $2,800. And then the life insurance, same thing. It's the $4,000 premium times the 40% that they tell you that the employee pays that we're withholding, and then we're going to turn around and remit. So we have a payable until we do that. So that's the $1,600. Then we have union dues that we withheld that we're going to have to pay to the union. So we have union dues payable of $1,000. And then we have salaries payable for the net, because FUTA and SUTA aren't part of the salary expense and withholding entry. They're part of the payroll expenses that the employer pays. So those aren't part of this entry. Okay, so we can ignore that piece. All right, so then they want us to prepare the journal entry to record the cash payment. So in order, when we go to pay that salary, we're going to reduce our salaries payable by $217.60, and we're going to reduce cash $217.60. Make sense? All right, so if we are to assume that FICA taxes are identical to those employees, they want us to prepare the accrued employer payroll taxes and other related employment expenses for July. So we did the withholding side from the employees' paychecks. Now we're going to do the employer side. So on July 31st, we're going to have payroll tax expense. We'll come back and sum up what those credits are to get our debit amount. But employers also pay Social Security, and they also pay Medicare. So Social Security and Medicare tax payables for the $22,320 and the $5,220, same as what we withheld from the employee. We also pay it on the employer side, right? And then we have state unemployment tax payable, and they tell us that $50,000 of their wages are subject to unemployment taxes, and they tell us that the rates are 5.4 and 0.06. So the state is 5.4, so 5.4 times $50,000 is $2,700, and then the federal is 50,000 times 0.6, which is $300. And then we also have to record the employer side of the life insurance premiums and the medical insurance premiums. So we have $30,540 of payroll tax expense, but then we also have to record the employee benefit expense. So we have employee medical insurance premium payable, which is the 60% left after the employees paid their 40. So that's $4,200, and then the life insurance is 60% of the $4,000. So we have total employee benefit expense of $6,600. Okay. All right. The fourth journal entry is to prepare the cash payment of all the liabilities related to the July payroll. So I know we can't see that here on this slide, what we had recorded before, but we had recorded total of $44,640 of Social Security payable, 22 on the employer side, 22 on the employee withholding side. About $10,440 for the medical insurance. We had $5,220 on the employee side, $5,220 on the employer side. So you reduce both of those liabilities. Then you reduce your federal income tax liability, which was $90,000 on the previous slide. Then the state income tax payable, we're going to reduce that, which was $20,000. The medical insurance payable that the employees and the employer pay for the total, $7,000, reduce that payable. Reduce the employee life insurance payable, which is a total of $4,000. Union dues was a total of $1,000. We'll reduce that payable. Then we're going to reduce our state unemployment payable as well as our federal unemployment payable and our credits to cash. So all those payables you put on your books, you just take them all to zero, basically. Okay? All right, so same exact problem, different numbers. Let's take an opportunity to see if you can't figure this out on your own, and then you can resume the recording when you're finished. Let me get the table here for you. Oh, they're going to do it one at a time. So figure out what portion of the premium for the medical insurance and the life insurance is the employee's responsibility and what portion is the employer's responsibility. And then record the journal entry for the employee side, then the journal entry for the employer tax side, and then the payments of those as well. And then you can resume the recording and we'll go through them all. All right, so the medical insurance premium was $15,400. The employee pays 40% or $6,160, which means the employer is paying the net of $9,240. Life insurance was $12,300 times the employee percentage, which is $4,920, and the employer pays the net, which is $7,380. Then we prepare the journal entry to record accrued payroll, including the employee deductions for July. So we have sales salary expense for $640,000 and office salaries for $128,000. Those are both up here. Then you've got your FICA Social Security tax payable, which is $47,616. They tell you that. The Medicare they tell you is $11,136. Federal income taxes of $192. State of $43. Medical insurance is going to be for this $6,160. This is the employee paid portion. Employee life insurance is going to be this $4,920. Union dues payable are $8,400. And so you have a net salary payable of $454,768. Then prepare the journal entry to record the cash payment. We reduce our salary payable with a debit of $454,768, and we reduce our cash with a credit of $454,768. Then we need to record the employer side, right? So we have payroll tax expense. So we have the employer side of the FICA, Social Security, and Medicare, which is the same amount as the employee pays. Then we have state unemployment taxes, and they tell us that the wages subject to state unemployment taxes is $69,000. And they tell us that the state rate is 5.4 and the federal rate is 0.6. So 69 times 5.4 is a state unemployment tax payable of $3,726. Federal unemployment taxes of 69,000 times 0.0 or 0.6, $414. And then you have your debit to payroll tax expense for the sum total of all your credits of $62,892. And then we assume when the other thing we have to do is record the employee benefit expense piece of this payroll. So we've got employee benefit expense equal to the sum of the medical insurance and the life insurance that's paid by the employer. So that's the 60% from the chart on the previous page. So employee medical insurance payable for the employer portion that they pay for the employee, $9,240, and then life insurance, $7,380. So we have a total employee benefit expense of $16,620. Then, when we record the journal entry to record all the cash payment of all the liabilities related to the July payroll, we're going to reduce our Social Security and our FICA payables by both the sum total of the credit we put out there for the employee piece that we withheld and then the credit we put out there for the employer piece. We're going to debit our federal income tax payable to take it to 0. Debit our state income tax payable, take it to 0. Same thing with the medical insurance, but it's for the sum total of both, right? We put an employee piece and an employer piece out there. So with the total medical insurance payable is going to go from $15,400 to 0. We do that with a debit. Employee life insurance is going to be debited by $12,300. Employee union dues, $8,400. State unemployment and federal unemployment, debit those. We have credit to cash. All right. All right. So exercise 9-9. So Mess Company has 9 employees. FICA Social Security is 6.2 of the first $127,200 paid to each employee. FICA Medicare is 1.45% of gross pay. FUTA taxes are 0.6. SUTA taxes are 5.4 of the first $7,000 paid to each employee. Cumulative pay for the current year for each of its employees as follows. Compute the amounts in the table for each employee and then total the columns. So, subject to Social Security is up to $127,200 for each employee, right? So Ken made $6,000 total year to date. So we have all $6,000 subject to Social Security. For Tim, all $42,000 is subject. For Steve, all $87,000 is subject. For Michelle, only $127,200 is subject. Michael, all $106,900. Zachary, all $127,200. Lori, only $127,200 of that $129,700 is subject to Social Security. All of Kitty's wages and all of John's wages are subject. So we have $665,200 subject to Social Security. All of their wages are subject to FICA. There's no threshold, right? So all $684,000 is subject to FICA. Subject to FUTA taxes and SUTA taxes is the first $7,000. So all of Ken's wages are subject. But Tim, Steve, Michelle, Michael, Zach, Lori, and Kitty, only $7,000 of their wages are subject. That's the max, right? Only all $4,000 of John's wages are subject because he hasn't reached the threshold. So we have a total of $59,000 subject to FUTA. And then subject to SUTA is going to be the same thing. Okay? So for each company, compute the total. And remember to include the total any employee's share of the taxes that the company must collect. So total FICA is going to be $665,200, right? Times 6.2%. Total Social Security paid by the employer is going to be the same, right? You have an employer and an employee piece. Medicare, you also have an employer and an employee piece. So this 684 times 1.45. Employer and employee piece for a total of 19,836, right? Total FUTA is going to be 59 times 0.6%. It's only paid by the employer. SUTA only paid by the employer. 59,000 times 0.4 or times 5.4%, excuse me. Okay? All right, so why don't you pause the recording? Try this one. Compute the wages that are subject to each of the applicable categories. And then also compute the total taxes using the rates provided for both the employer and the employee side. And when you're finished, you can resume the recording and we will go through the answers. All right, so pay subject to Social Security. It's everything up to $127,200. So it's going to be equal to their cumulative pay until you get to Michelle. Only $127,200 of hers is subject. All of Michael and Zachary's salaries are subject to Social Security. Lori's only $127,200. And then all of Kitty and John's wages. Subject to FICA Medicare is all their wages, right? So it's just equal to their cumulative pay for every single one of them. Total $700,000. Pay subject to FUTA and SUTA, first $7,000 of each employee, right? So all at Ken's, but Tim, Steve, Michelle, Michael, Zach, Lori, Kitty, only $7,000 of their wages are subject to FUTA. And then John, all $4,000 of his. And then same is true for SUTA. Okay. All right, so compute the total for each of them using the tax rates, right? So you have FICA Social Security paid by the employee, $670,900 times 6.2. You have the same for the employer, right? Because you have an employee side and an employer side of Social Security. Same thing with Medicare, employee side and employer. It's just 700 times 1.45. Employee piece, employer piece, right? FUTA, 58,000 times 0.6. SUTA, 58,000 times 5.4. Total taxes. All right, exercise 910. Hitsu Company sold a copier costing $4,800, 2-year parts warranty to a customer on August 16th for $6,000 cash. Hitsu uses the perpetual inventory system. On November 22nd, the copier requires on-site repairs that are completed the same day. The repairs cost $209 for materials taken from the repair parts inventory. These are the only repairs required in 19 for this copier. And then based on experience, Hitsu expects to incur warranty costs equal to 4% of dollar sales. It records warranty expense with an adjusting entry at the end of each year. So, how much warranty expense does a company report in 18 for this copier? So, you've got your 4% of your $6,000 in sales, which is $240 in warranty expense in 18. How much is the estimated warranty liability for this copier at December 31st, 18? So, our 2018 expense, we said, should be $240, right? 2018 repairs were 0. So December 31st, we have $240,000 of warranty liability on our balance sheet. Then in question 3, how much warranty expense does the company report in 19 for this copier? So let's see, we didn't sell it in 19, so there's no warranty expense reported in 19. So in question 4, how much is the estimated warranty liability for this copier at December 31st, 19? Well, we made a repair in 19, right? And that reduces our warranty liability. So we started at $240 at the end of 18. Warranty repairs were $209. So we're going to have a debit to our warranty liability for that $209, which means we have a balance of $31 at the end of the 19 year. All right, so same information here, but the adjusting entry that they want us to record when the copier is sold would be a credit to cash. They tell us we got $6,000 cash for it, right? And a debit to cash, sorry, and a credit to sales. And then we have to record the cost of that sale, and they told us the cost was $4,800. So you debit cost of goods sold and you credit merchandise inventory for $4,800. Then they want us to prepare the journal entry to record the adjustment on December 31st for the warranty expense. So we looked at that in T account form in the previous slide. So we're going to record warranty expense equal to 4% of the sale, which is $240. We're going to record estimated warranty liability for $240. Okay. Then prepare the journal entry to record the repairs that occurred on the 19th. So the repairs are going to reduce our inventory and they're going to reduce our warranty liability, right? So we debit our warranty liability for the 209, which is the cost of the repairs, and we're going to reduce our repair parts inventory for 209. Okay? All right, so same problem, same question. So first, how much warranty expense does the company report in 18? I don't remember the rest of them, so we'll go piece by piece. So why don't you take a minute, figure out what the warranty expense is for 18, and then we'll move on to question 2. So the warranty expense for 18, they tell us, should be equal to 5% of the dollar sales. So 5% of 11,000 is 550. So that's how much warranty expense we have for 18. How much is the estimated warranty liability for the copier as of December 31st, 18? Well, our expense is 550, right? And we didn't have any repairs. So at the end of 18, it's still 550. Then how much is the warranty expense does the company report in 19? None, right? There was no warranty expense because there were no sales. So how much is the estimated warranty liability for the copier as of December 31st, 19? Well, we started at 550. We had repairs equal to 141. So we have a net credit of 409. Now they want us to prepare the journal entry to record the copier's sale. Credit, cash, debit, sales, right? For that $11,000. Then we have to record our cost of goods sold. $5,500 they tell us, and we're going to reduce our merchandise inventory by $5,500. Then we prepare the journal entry to record the adjustment on December 31st. To record the warranty expense. So we are going to record 5% of 11,000, right? So our warranty expense, and then our estimated warranty liability of $550. Then prepare the journal entry to record the repairs that occur on November 19th. So when we record the repairs, we're going to reduce our warranty liability and we're going to reduce our inventory, right? So we're going to debit our estimated warranty liability for 141 and we're going to credit our repair parts inventory for 141. All right, exercise 911. So for the year ended December 31st, Lopez Company implemented an employee bonus program. Based on their net income, they expect their bonus expense to be $14,563. So prepare the journal entry at December 31st to record the bonus due to the employees. Employee bonus expense is a debit of $14,563 and bonus payable is $14,563. Prepare the journal entry at January 19th to record the payment of the bonus. So we're going to reduce our payable and we're going to reduce our cash, right? All right, so same problem, different numbers. Why don't you pause the recording, try it out. When you're finished, resume the recording and we'll go through the answer. All right, so the journal entry to record the bonus due to employees at December 31st. We debit employee bonus expense and we credit bonus payable for $65,000. And then when we pay it, we reduce our payable and reduce our cash, right? Hope you did well on that one. Exercise 914. All right, so the following information is for separate companies in A through F. And what they want us to do is compute the times interest earned ratio. So that's income before interest and tax divided by interest expense. And so the trick here, though, is that they only give you net income, interest expense, and tax. They don't give you income before interest and tax. You have to compute it. Well, how do you get back to income before interest and tax from net income? You add interest expense back and you add income tax expense back, right? So 115 plus 44 plus 35 is 194 divided by interest of 44 times interest earned is 4.41 times. Letter B, 110 plus 16 plus 50 is 176. Divided by 16 is 11. In letter C, 100 plus 12 plus 70 is 182. Divided by 12 is 15.17. In letter D, 235 plus 14 plus 130, 379 divided by 14,000 of interest expense is 27.07. In letter E, 59,000 plus 14,000 plus 30,000 is 103,000. Divided by 14,000 is 7.36. And then in letter F, $5,000 of net loss, add back 10,000 of interest expense. You have 5,000 of income before interest and tax, divided by 10,000 of interest expense is a times interest earned of 0.5. That's a pretty bad one, right? All right, so same problem, different numbers. Why don't you take time to go through A through F, and when you're finished, resume the recording, and we will go through the answers. All right, times interest earned is income before interest and tax, divided by interest expense. So again, we have to compute what our income before interest and tax is by adding back interest and adding back income tax to our net income or net loss. So 138 plus 78, 660 plus 34, 500 is 251, 160. Divided by interest expense of 78, 660 is 3.19. Same math for letter B. You should have computed 5.12. Same math for letter C. You should have computed 30.6. Letter D is 4.55. Letter E is 8.26. And letter F is 0.31. So how'd you do? Hopefully well. All right, so this is it for the Chapter 9 exercises. As always, if you have any trouble working through the homework problems or something's just not clicking right with you, please don't hesitate to reach out. Otherwise, best of luck on Chapter 9. Take care, guys.